Welcome to Bloomberg Markets. I'm Scarlett Fu. We are roughly halfway through today's trading, so here is where things stand. You look at the S&P 500 and the NASDAQ 100, big cap stocks are in the green once again, with both these indexes resuming their July advances. They're recovering from yesterday's decline. But you look at the Russell 2000, small caps are extending yesterday's surge. Traders increasingly convinced the Federal Reserve will cut rates in September after today's decline in consumers' inflation expectations in the Michigan report and yesterday's CPI report, which are more than offsetting a somewhat hotter wholesale inflation print. Now, looking at dollar-yen, dollar weakness here because of the prospect of lower rates, and that's the case against most of the G10 currencies, in particular versus the Japanese yen. And let's take a look at what's happening here, because here's a 5-day chart of the pair. And you can see that the big drop in the dollar yesterday, right around the time that the CPI report was released at 8:30 a.m. Japan's government likely intervened right around then, with Bloomberg calculating it spent around $22 billion to support the Japanese yen. As for company news, earnings season is underway with the big banks publishing their results. JP Morgan announced the highest quarterly profit in the history of American banking. Its investment banking fees soared past analyst estimates, and equity trading revenue jumped 21%. But net interest income fell short of estimates, and expenses also climbed more than expected. Let's now look at Citi. All its major divisions saw revenue gains compared with last year. Quarterly revenue rose 38%, but Citi also warned that this year's costs are likely to be at the high end of its range. And looking at Wells Fargo, it posted its lowest quarterly net income in the past 2 years and also reported higher than expected costs, weighing on shares. So let's unpack all these results and find out what it says about results from Morgan Stanley and Goldman Sachs with Bloomberg Intelligence senior bank analyst Allison Williams. Allison, great to speak with you. Great to have you here in New York. Let's start with the bread and butter business of banking, which is lending, whether it's to consumers or businesses. That makes up the lion's share of business at all of these big banks. How does the bread and butter business look, that lending business, compared to the Wall Street businesses?
So, not great. I think that's where we saw the weakness at Wells Fargo this quarter. The big negative news is just that they're going to have less net interest income going forward. And part of that is that loans are coming in weaker than expected. So they came in weaker and they expect that to continue, especially on, as you said, sort of the bread and butter, which is the commercial business. Card is the business that continues to grow. So we're seeing good loan growth there. But we're also seeing banks setting aside provisions. Part of that is just you see growth, you see provisions. Yeah. But we are seeing some weakness at Citi. We are seeing, the specific area where we're seeing weakness tends to be a lower income bucket. So I think that is a concern. That's seasonally better in the second half, but I think some of the numbers there, don't give us the most comfort that that's going to improve. By contrast, as you said, capital markets really booming.
So that's the interesting thing, because certainly that's bounced back in the first half of 2024. But is it sustainable? Because at Citi and at Wells Fargo, fees were up year over year, but down quarter over quarter.
So there is a seasonality, and the seasonality starts the strongest in Q1 and ends the weakest in Q4. So there is a seasonal element to your point. But we have looked at trading, and it is resilient when you look at on a year-over-year basis. So some weakness quarter to quarter, but the equities markets are booming, and that's really helping the equity side of things. Prime brokerage has really helped. Credit trading also doing well. We're getting some help from the primary calendar, right? So investment banking fees are good, but that's also helping trading activity. And then the markets are good for the wealth and asset management business. That's, sort of just the math goes into higher assets, and then the hope is that also bring flows into it. On the fee side, there still is a lot of room for M&A and IPOs to get better. I think a lot of that will depend on the Fed in the second half.
All right, great stuff. Bloomberg Intelligence senior bank analyst Allison Williams taking us through the start of bank earnings season. Let's build on this discussion and now bring in Betsy Duke, who's worn a number of hats through her career. She's a former Fed governor, the former chair of Wells Fargo, and the former chair of the American Bankers Association. Betsy, it is so good to speak with you, and we're both wearing red, so we match. match.
Yeah.
I want to start with banks in our conversation here. The Fed's rate hike campaign has been really good for the industry because higher rates increase their net interest income and their net interest margins. But the first quarter and second quarter numbers suggest we might have seen a peak in net interest income. Why is the industry no longer benefiting from persistently higher interest rates?
Well, you have a couple of things. You have different timing in the repricing. So when rates are moving very quickly in one direction or another, that's going to kind of scramble net interest income. But as rates begin to stabilize, then the balance sheet effects will begin to move. Assets will reprice to current rates and liabilities will reprice to current rates. One of the things that the banks have had an issue with is how long it has taken them to get their deposit rates back up closer to market.
Yeah. What would the start then of a rate cutting cycle mean for the profitability of these banks' lending business, whether you're a big bank or perhaps a smaller bank?
I don't think right now you're looking at enough cutting to make a big difference one way or the other.
Okay. Yeah. I mean, at first we have to get to that cut, right?
Exactly.
Loan loss provisions at JP Morgan and Citigroup rose. Wells Fargo reported higher charge-offs, mainly due to commercial real estate charge-offs. What's your initial read right now on credit quality, given where we stand in the economy?
To be honest, I'm not watching any individual bank that closely, so it's hard for me to say.
Okay.
I think the credit quality generally is pretty good, and I don't really worry about the drag that office markets will have on bank earnings, because the loans for offices, while they're out there, they're not huge parts of any of the large bank portfolios anyway.
Okay, let's talk about one of your other hats, which is as a former Fed governor, and talk about inflation, because yesterday's cool CPI data sparked a massive rally in small caps. Today's UMichigan survey showed a drop in inflation expectations. We know that Chair Powell told Congress that Fed officials need to gain more confidence before cutting. Did these data points provide that confidence, do you think?
I think it's going to take a few more, but certainly every good data point provides a bit more confidence. If you looked at the confidence or the uncertainty that they had in their last projections, they were, at least half of them were pretty confident in their projections on growth and their projections on the unemployment rate. So they had confidence there. Where they didn't have confidence was in their projections on inflation. And the movement in those projections, I went back and looked, June of 2023, the projection was 2.6% on core PCE, dead on the last reading that we had. It came down to 2.4% in December, then went back up to 2.6 in March and 2.8 in June. And in June, only about 2 of the participants said that they had normal levels of uncertainty, and more than half of them said that they thought the risk was too higher inflation. So we've got time between now and September to get good solid readings at 2.6 PCE or better. And I think if you get those, that you will have a strong majority feeling comfortable in beginning to move on rates. I don't expect it to be teed up after the next meeting, but I would expect the door to be open to a rate decrease in September if the data continues to come in right around where it is now.
So they may not set the table for a September rate cut in July. So that puts the onus on whatever Jay Powell says at Jackson Hole, doesn't it?
I don't think he's going to make news at Jackson Hole on their intention. I think it has a lot more to do with how the readings come in, and I can't remember if they have 2 or 3 readings between that meeting and the September meeting, but that's what it's going to depend on.
Got it. Betsy Duke, really appreciate your joining us as always. Betsy Duke, a number of impressive titles in her past, including former Fed governor and former chair of Wells Fargo. And banks, by the way, can take some comfort in the rest of their prime brokerage business following the conviction of Bill Hwang of Archegos, according to Bloomberg Opinion's Paul Davies. We're going to discuss all of that with him later on in the program. But first, AT&T shares are down after the company was hit by a massive data breach. We're going to have all the details next for all you AT&T customers. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, which is AT&T. It is lower after the company announced a massive hack of customer data. The breach included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. Joining us now is Bloomberg's Brody Ford. Brody, this happened 2 years ago, a year and a half to 2 years ago. How did we learn about this? Did AT&T make a big announcement, or was it kind of just under the radar?
Yeah, 6:30 this morning, checked the 8Ks on Friday, right? In a filing, they said that, hey, nearly all of our customers' call data was revealed. And that's not like, exactly what was said, but who called who and when, right? It's not hard to see how damaging this can be, right? Who called a lawmaker before a specific bill? Who called an executive before a decision was made? I mean, this is pretty sensitive stuff that a bit of a nightmare scenario as it relates to disclosure of information.
And now the FCC is looking into it, and you've got national security experts talking about how this is a breach, an undermining of U.S. national security.
Yeah, absolutely. Because again, think about the government use cases. I mean, journalists, right? Who called us before a big story went out? And what's interesting here is that with this AT&T hack, it's part of a larger campaign targeted at customers of Snowflake, right? A company where they help you store and analyze some of your most important data. We've seen folks like Ticketmaster, Neiman Marcus breached. And it's been this kind of slow drip of customers impacted. They count many of the world's largest, most important corporations as customers. And so it's hard to not think, man, who else has been breached that we don't know about yet?
Do we have any idea who might have done this?
Yeah, I think it's currently unclear if this is exactly the same hackers that have breached the other folks. It is unclear exactly who they are. Researchers from cyber firms have said it appears to be folks in the US doing this. They have tried to extort folks for money, right? I think they were requesting $2 million from Ticketmaster to stop all the chaos. So it appears to be profit motivated at this point, but still, are they going to go sell that data to somebody who might use it for more nefarious purposes? Again, thinking about government security, it appears on the table.
All right, so nothing is off the table just yet, but clearly some bad actors at work. Bloomberg's Brody Ford, thank you so much for getting us the latest details on this. Speaking of bad actors, let's turn to today's big take, which focuses on the destruction of the undersea research cable off the coast of Norway that was destroyed back in 2021. Bloomberg investigated a worrying pattern of missing underwater cables. Our Jordan Robertson looked into whether Russia may be behind it.
In 2021, an unexplained incident occurred off the coast of Norway. An important undersea data cable had been damaged, and no one could explain why.
Something was obviously seriously wrong. Nothing worked anymore. No instruments, no sensors. Where the cable was supposed to be, there was no cable. You just see mayhem.
At the bottom of the world's oceans lie an essential network of data cables. They stretch hundreds of thousands of miles around the world.
Information flow, communications, banking system, financial communications, it's a vast network and it's extremely vulnerable.
Damage to any of them could be catastrophic.
It could spread a panic, disrupt the normal functioning of states.
In the last few years, there have actually been a whole series of incidents involving undersea cables. These may not be freak accidents. They may actually be a sign of something more sinister. Sabotage.
That was Bloomberg's Jordan Robertson, and you can catch the full story on Bloomberg.com, or you can listen to more of our reporting through the Big Take Daily podcast. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Let's take stock of a big verdict this week that mesmerized Wall Street. Archego's founder, Bill Hwang, found guilty of criminal charges stemming from his firm's 2021 collapse that concluded a 2-month trial. Again, captivating Wall Street was responsible for the demise of Credit Suisse. Bloomberg's Sridhar Natarajan reported on the trial. Sri, just remind us once again of exactly how Bill Hwang's fund imploded. He made massive bets on a couple of stocks.
Well, a handful of stocks. So there were some 10 key stocks in the post-pandemic period that he really bet on. And when I say really bet on, he bet the entire house on it. He went from roughly $4 billion in assets to $36 billion in a span of just 6 months. And from $36 billion to zero in about 4 days. So it was one of the most extraordinary Wall Street stories. Here was someone who had made the boldest, most riskiest bets away from plain sight. No one really knew the scale or the size of his bets, and that was the big problem. Not even his banking counterparts, not even his partners in the banking industry who were helping him put on these bets. That was $36 billion of net assets. The entire wager, when you include the leverage, was $160 billion. That is an unfathomable amount, and the fact that you went from there to zero in a matter of days is an extraordinary story that we're not going to forget anytime soon.
I really like how you highlight the scale because that's what gets everyone's attention. So let's bring in Bloomberg Opinion's Paul Davies, who's written about this. The title of his column, Archego's Couldn't Happen Again. Could it? Maybe it could. Paul, we heard from Sri about how the banks didn't know what was going on. What is the lesson here for banks that Bill Hwang can be behind some of these big trades and build up these positions and be making these moves without his bankers knowing any the better?
Yeah, I mean, I think there's a couple of lessons. Partly having a counterparty like Bill Hwang is always going to be somewhat down to trust. Banks are never going to allow other banks to look at their portfolios with certain big hedge fund investors. The hedge funds don't want it. The banks don't want it. It's too much kind of commercially sensitive information. There's going to be some better disclosure, I think, around some of these sorts of trades. But there's always the possibility that somebody will be able to con you. But I guess the thing is that luckily this is a very, very unusual case. It's very rare for somebody to really be as dishonest as they've been convicted of being about what positions they had with other counterparties, with other banks. And at the same time, as my colleague Matt Levine has written, his trades didn't even make any sense. It's like, what was the get out? Nobody can really quite understand where he was going with this. And if you can't make any sense of what someone is doing, then it's really hard to spot them.
So I want to preface this by saying I agree with 9 out of 10 things that Paul says. But the one thing I want to be careful about in this instance is, yes, a lot of what Bill Hwang was doing was a man taking on extreme risks and bending a pliant system to his will. But at the same time, we also have to acknowledge the fact that there was very clear Wall Street folly here. If I were to try and get $1 million mortgage at a bank down the street, I can't just go in and say I make X amount, trust me, you don't need any proof. And here was someone who was giving them vague, verbal, evasive assurances, and the banks were happy to lend out billions and billions and billions of dollars in firepower. That is where I think the system broke down a little bit. It was, now that you see what happened in the trial, some of the documents that have come out, the ease with which the banks believed their client, to some extent wanted to believe him because they were making a lot of money off him and continued to fund his bets, that I think was a problem. And I think that has to change. Yes, you will never get to a place where you will have 100% visibility into what your client is doing across all their prime brokerage relationships, across all their counterparties. But you still would hope that the system will allow for these banks, allow for these counterparties to be able to ask more probing questions. You hope that's what the risk function does, and that's when you will force them to give more real, believable answers.
So it sounds like risk management did not do its job, Paul. These are transactions between sophisticated investors like Bill Hwang's fund, his family office, and sophisticated bankers. Both sides should be fully aware of the possibility of things going haywire, shouldn't they?
Yeah, no, absolutely. And Sri is dead right. I mean, some of these banks were really chasing this business in a very unwise and even reckless way. I mean, you read the detailed independent lawyers report into what happened with Credit Suisse, which suffered the biggest loss at sort of more than $5 billion, I think it was, on these trades. And just the scale of just bad management and bad culture behind what went on at Credit Suisse in particular is just startling. But there were other banks equally who turned down Bill Hwang, who turned down Archegos. You know, they came there looking for leverage and help and backing, and was turned away. So there was kind of a mixture across the banks, but some of them really were about as reckless as you can be.
So, Sri, you cover the big banks, you cover Goldman Sachs, you cover Morgan Stanley. How has the Archegos disaster and the blow up impacted the way they operate? I mean, do you see them doing things differently as a result of what happened here?
It's hard to get a full window into exactly what they're doing. It's fair to say that in the immediate aftermath of the collapse, obviously all risk management operations must have been on high alert. They were willing to look under every rock carefully. But the question is, as we get further away, now we're already 3 years past the Archegos collapse, and as we get further away from it, how long does this remain in your memory? And how quickly does the lure of new, promising, attractive fees ensure that this fades away in the rearview mirror?
Yeah, always good questions to pose, especially during bank earnings season. Bloomberg Opinions, Paul Davies, and Bloomberg News reporter Sridhar Natarajan on the Archegos lessons that banks may or may not learn moving forward. That does it for this hour of Bloomberg Markets. You can see we have green in equities right now, with the S&P and the Nasdaq resuming their advance for this month. Yields coming down here on the 2-year and the 10-year, 4.19%. The latest University of Michigan Consumer Confidence Survey showed inflation expectations dropping down to a gain of 2.9%. That was encouraging following yesterday's cooler than anticipated CPI report. There's a lot more conviction behind the idea that the Federal Reserve may move forward with an interest rate cut as early as September. From New York, this is Bloomberg.